Good afternoon, everybody, and thank you so much for joining us this afternoon for our Fireside chat this afternoon with Marcy Frost, CEO of Calpers, on the topic of rethinking capitalism and rethinking growth. I just want to say what a pleasure it is to have an opportunity to talk with one of the most interesting people I have ever had the pleasure to interview in the context of a challenging job and one of the most fascinating organizations around. Calpers is certainly a large organization, Marcy. I think it's important for us to start off for you giving us a bit of context about Calpers as an organization, putting it in perspective. To my understanding, you're the largest North American pension fund, one of the top 10 in the world, and you certainly are responsible for a large number of beneficiaries and individuals out there in guiding that pension system. So maybe you could talk a little bit to start with about how you think about your role as CEO as such a large institutional investor. And then maybe we can dip into the issue of where we are in the state of the economy.
Yeah, thank you. And so happy to be here with you all. Calpers, we have a very important mission. And really, I think of Calpers in the context of being able to provide retirement security for 2 million people, primarily in the state of California. We obviously have some individuals who, after retirement, choose to relocate to other places. But not only are we the largest U.S. public pension plan, but we're also the second largest purchaser of health care beyond the federal government. So we have this dual policy mission, but it really is all aimed at providing retirement security, providing some, dignified forms of capital and wellness throughout someone's lifetime. So I'm very connected to that mission. I think our entire team is very connected to that mission. If you want to work at Calpers, those are certainly the questions that we will have about, do you feel this connection to helping Calpers to be successful in being able to offer these retirement plans and healthcare plans to 2 million people. We pay out over $25 billion in retirement income to individuals, and I really consider that deferred compensation. These are public employees who have decided to dedicate their careers to public service, and at the end of that public service career, they have this form of income being provided to them, and we take that obligation quite seriously. About 60 cents of every dollar that gets paid to a pensioner is made out of the investment earnings, which of course is why the portfolio at roughly about $415 billion is so important. And we spend a lot of time thinking about our strategy and thinking about how do we look at the long term? How do we make sure that this fund is sustainable, that it's an evergreen fund, that it's available for, the next generation of public sector workers?
So that's a point I'd love to talk a little bit more about, Marcy. When it comes to the context of sustainability of a pension fund is the critical thing. And that means being able to operate through the highs and lows of the global economy. And right now we're going through one of the most challenging times, a global pandemic, a very uncertain, volatile global economic environment, and a lot of uncertainty about what the future looks like. And as a pension fund, as you said, you're a long-term investor. You need to be thinking about that. And the success of having a stable global environment in which to invest, to earn those returns that your beneficiaries need. I'm just wondering if you could share us some of your thinking that you've been having with some of your investment team about this. And how do you think about operating under this current environment? And how does that possibly make you change your strategy or think about your investment horizons over let's say, the medium term?
Well, we're certainly a long-term investor. As I mentioned, our mission is really to be evergreen for, decades and generations to come. But the importance of the investment portfolio cannot we have to really be thoughtful about how we invest the assets of our 3,000 public employers who are participating in one of the retirement plans to the 2 million people who have contributed or are contributing. So, our strategy is to remain focused on the long term. We do know that short-term disruptions in the markets, something that we have to pay very close attention to, liquidity, risk mitigation, those are all strategies that certainly came into play during the COVID impacts. to the markets. And, we have a strategy that 7%, we have a 7% return target. And at the same time, again, paying out that $25 billion. So liquidity and being able to manage our liquidity appropriately during, either a downturn in the market where we want to exploit some opportunities. And we were able to do that this time because liquidity was managed quite well, to really thinking about who should our strategic partners be as an investor who has a pretty strong reliance on the private markets. We want strong relationships with the GP, the general partner community, because we have about an 8% policy target to private equity. We're trying to build about a 5% policy target to private debt or private credit. And then we also have a policy range that was just approved to be able at the total fund level to be able to apply about 20% of leverage if we see that there are opportunities that present themselves at an attractive rate to a long-term investor like Calpers. So, we have to think about the strategy. We have to think about the low interest rate environment. We have to think about the fact that the Feds did a remarkable job here in the U.S. of really shoring up the markets and not, allowing some of the lessons that were learned out of 2008 and 2009. Those certainly did not play out this time. But I think it has caused the markets to be a little overvalued. So that's an area we might be a little concerned about and cautious about. But it's all really targeted at this 7% return assumption. And we have to take a lot of risk. We have to take risk domestically, and we have to take risk internationally. No matter where we deploy money, it's really, difficult for someone the size of Calpers and the scale to hide anywhere. So our thought is really around risk mitigation. Being long-term means we can be patient. I think we are a form of patient capital, but we want to understand better the risks that we are taking with our capital meaning the beneficiary's capital. So, if it's a public company, we want to know how that public company is really managing the risks around climate. We see three critical risks to the system here at Calpers. One is the 7% return target that I mentioned. The second is the employer, the 3,000 participating employers here in the state of California, their ongoing ability to pay the contribution rates. And that becomes problematic when Calpers is not able to hit that 7% return target. That any delta between the number that we actually received last fiscal year, we were able to get a 4.7 return. And we felt pretty good about that relative to our peers, meaning, from a peer standpoint, similar asset allocation, that was around a 3.1, 3.2 return environment. So getting a 4.7 in that type of environment, the team feels good. They feel confident the strategy is working and that it's on pace, but we didn't hit our 7% return. So that delta, that difference really does move over to the unfunded liability of the system, of which the 3,000 participating employers are the ones funding it. And when you're a system like Calpers, and we haven't fully recovered back to, 100% funded, I don't know that 100% funded is the right number to strive for, but certainly anything over 90% when we are sitting at a funded status of roughly 71%. So we think about sustainability, we think about risk. We need a lot of data, a lot of metrics for us to be able to understand from a public company or a private company whether they're managing those risks appropriately over the long term, or is there too much emphasis and focus on the short term. So those are, some of our ongoing thoughts, and really have not changed through COVID-related market downturn or slow global economic growth. These are just basic tenets of the way of a long-term investor really thinks about the portfolio.
Right. I would totally see the reason for having any pension fund has to have a long-term approach, as you say. But as I think you also pointed out, one of those things top of mind now in looking at returns is sustainability, is the impact of climate change. There are new factors that I think all institutional investors and businesses everywhere are thinking about when they look at the risks of climate change, because climate change is both a significant risk to existing assets, as you well know, as well as being an economic opportunity down the road. So I'm just curious, as one of the largest pension funds, and you sit on a lot of global committees where some of this thought leadership happens, what's your thinking about how Calpers is embracing this issue of having a whole of focus on climate change, on sustainability, and just more broadly on ESG issues? Because this goes not to beyond just climate change, but also the issues of diversity and inclusion, and just simply building resilient, well-managed businesses that can deal with all of these different aspects. And I assume in your role of leadership, this is something top of mind right now in how you're thinking of building that sort of next generation of investment strategy.
Right. So the third risk, so I mentioned the 7% return target, then the employer affordability. And then the third risk for CalPERS, and we think about this short term and long term, is related to climate. But also I can talk a little bit about our ESG strategy and how that has been reshaped a bit around a risk framework and an engagement framework and an advocacy and policy framework. So, we've done our first TCFD report on our portfolio. We sit at about 3.23. And, now that we have this data, we've done all of the analysis on scope 1, scope 2, and scope 3 emissions. We know the action plan that we need to take. And a lot of that is related to the engagement with public companies. How are you managing these risks, the advocacy and the policy work that we're doing with governments? And what's really important is that we need to convene like-minded investors like CalPERS. And there are many like-minded investors around the world who are thinking about long-term risks, who are thinking about more responsible investing, more sustainable finance, as another example. So, some time ago, we were a co-founder of Climate Action 100. We engage privately with a number of companies, and it's really to understand how are they managing these risks to their business model that they, based on consumer demand, based on, 2050 net zero emissions, which many companies have not now started to commit to. We have made that commitment at CalPERS, and we're involved with a number of like-minded investors, people who think about capital deployment in the way that we do, that you have to think about physical capital, human capital, you have to think about financial capital. And, there's a high correlation between financial capital and human capital. So when we think about our ESG framework, the environment is really the climate-related disclosures, the climate-related metrics that we know and understand that a company is paying attention to it and that they have a plan to really work through all of the different business planning cycles that will happen over the next 20 to 30 years. And I think what's most imperative there is that we have a standardized set of metrics like the TCFD, and there are many others. I know you're on ILPA, and that's a great organization for limited partners like CalPERS, because, even though CalPERS is the biggest, CalPERS cannot do these things on our own. It's going to take government regulation. It's going to take consumers. It's going to take companies. It's going to take everyone working toward these common goals and these common outcomes as it relates to climate, as it relates to human capital and the way, people are really treated in these companies. And are they treated in a way that, that they're able to recruit the talent that they need to be successful? And then once you recruit that talent, you have the ability to retain the talent once you hire them. And that's really, we have the same expectations internally at CalPERS and the way that we do talent management. We're going through our, 5-year strategic planning cycle right now. And, one of the key parts of our success, or the key, kind of underwriting of the way that we will be successful as an organization, is our ability to recruit the talent to execute on our strategies, whether that's an investment strategy, whether that's a health policy strategy, whether that's just a pension administration or actuarial strategy. So we really think about human capital and how talent is being managed in the companies where we're invested in. And those expectations really are not different whether you're a public company or whether you're a private company. And that's why we really like this ILPA framework, because it creates a consistent set of standards, expectations from the LPs. Because sometimes what you would have to be careful of is that many of these public pension plans have a pretty significant reliance on private equity. And if we don't have some conformity in the way the LPs have expectations or the way the LPs behave, it's easy to do a little LP shopping, if you will. And so we want to be in a place that we're standing side by side with our cohorts and having those same expectations. And I would say it's the same thing for climate. It's the same thing for human capital. And really, again, all about, we don't want to tell companies how to run how to run their business plan or how to run their business operations. That's not our expertise. What is our expertise is to be able to take data and analyze that information and use it to decide whether we stay invested in that company or whether we say we think there's too much unmitigated risk here and we need to move those assets somewhere else. So this information is really important, both making the short-term decisions, but even more critically, the longer-term decisions around sustainability of the Calpers Fund.
Yeah, that's a great way to look at it, Marcy. I think one of the things you were talking about was the strength of numbers in the terms of institutions coming together. As you said, it can't just be CalPERS who's solving all these very thorny issues around standardization, sustainable practices. And as you mentioned, the Institutional Limited Partners Association, ILPA, is one of those groups of investors who's trying to create some frameworks that everybody can help come together to create transparency in the market about what we expect of fund managers, general partners, and what institutional investors, the limited partners, should be expecting as well. And that on both sides, there needs to be sustainable practices, and there needs to be good management practices around, as you say, that valuing of all aspects of human financial capital and good governance. On that basis, maybe we can talk a little bit about what you see as the state of the private equity industry, primarily North America, I would say, but also globally. I mean, you're involved globally as an investor. There's a lot of controversy around private equity sometimes about, whether it's always doing the best for businesses, whether it's really thinking more responsibly about the future and investing sustainably and really value adding to companies. What kind of role do you think it makes sense for an organization like CalPERS to play to try to push that industry forward into a more maybe responsible model of how it operates as it tries to seek those returns for you on your behalf?
Right. So again, being that largest U.S. Public pension plan, there's certainly a number of our own. I've started to call them shareholders rather than stakeholders who really want us to push more into the private equity space, push our investment beliefs or our, beliefs in our environmental, social, and governance policies as well. And the private industry, they sometimes can say, well, there's a reason we're private. It's the reason we took a public company private. But I think more recently, I would say over the last 5 years or so, if you are having, you're attending these events that the GPs used to hold in person and now are holding more virtually, they really are thinking about climate related risk. They're starting to think more about human capital. I think human capital is the one area where we need to engage as the entire LP community. We can't, again, do this on our own. We'd like to use our voice to influence and have an impact on the matters and the policies that really are important to all investors, not just CalPERS as a single investor. But I think the private equity space, they have a return hurdle and, benchmarks, and we talk about private equity benchmarks all the time. So, or public equity plus 300 bits or 150 bits. But, that's an ongoing topic for us. But, I think a lot of the LPs have just gotten to the point where, returns are not enough. We want returns. We certainly expect returns collectively. We do know likely that in the buyout space, some of those returns are going to be muted for a bit. We just did a strategic review of our own private equity program, and we, have some discoveries and things that we needed to change in our own strategy. And one is we were not taking full advantage of co-investment opportunities and co-investments. I think the other critique that goes to private equity companies are the fees, right? The carry fee in particular. But I think how we would see it is if we're paying carry, if we've negotiated a great agreement, if we're paying carry, it means that the fund is doing well and that we are willing to pay for some of that performance. But we're not willing to pay for, performance that is not helping us to achieve our 7% return or helping us to really impact the sustainable investing side of what's critically important to the long-term nature of the fund. So, I think this is an area where more LPs need to come together and really, consider. Again, I would use ELPA to do this, frankly, because it can't be a single LP going at a group of GPs or a single GP. But I think the GP community is understanding this more. The buyout space tends to be a little noisy for someone like CalPERS, where whether it's a private equity company who has, a set of hospitals, whether it's a private equity company who had a retail that, was not able to be turned around appropriately. It got over leveraged. And so we hear a lot here at Calpers around private equity, but what we also know is that we need private equity, but we need the right type of private equity, meaning we need access to the right managers. We need to take more advantage of co-investments, separately managed accounts or customized investment accounts, and really think about the fund vintages that are more oriented toward growth versus buyout. Buyout tends to be a little noisier for us, but I do think there are many opportunities for the LP community to talk with the GPs. I believe the GPs are purely open to this, but we always have to be mindful that this return orientation is a top priority when we've got an 8% policy target to private equity today, and our actual, deployed assets is around 6%. And so if we're basing our 7% return target because we believe private equity and private debt are the two asset classes that will give us greater than the 7%, I don't want our voices to be muted because we need GPs more than they need LPs. Sometimes in the fundraising cycle that happens. But what happens if the entire LP community has the same set of expectations of the GP community? How much progress, how much traction could we really make? And I think we could. And I think Calpers certainly has a leadership role, and either a convening leadership role or just we have a number of ideas in this area that we'd be happy, to share, at another time or through ILPA itself.
Yeah, and we look forward to that. So maybe another thing I'd like to just touch upon, given we're fairly close to the top of the hour here, Marcy, is this issue of kind of where you are at this juncture. You've been in your role as CEO now for about 4 years. That's probably a time to give you enough of chance to reflect in the course of maybe one strategic walk through your plan and think about the future. And so maybe you could just give us a bit of a sense of what you see as some of your key accomplishments that you've seen to date, and maybe what you see as sort of the significant challenges that you're kind of bracing for as you move ahead into this next stage of your leadership at the top of North America's largest pension fund.
Great. Yeah, thank you. I appreciate that question. Yeah, I would say that things that we're most proud of as an organization, and I'll start, maybe a few years ago, is, coming into Calpers. I came out of the Washington State system. Coming into Calpers, the return assumption was 7.5. And when I, did my own homework before I took the position, we saw the capital market assumptions, we saw the long-term actuarial rate on the current policy, the strategic asset allocation, and it wasn't, 7.5 was a hard number to get to. And if you looked at, the economic outlook or the environment ahead of us, it wasn't going to be any easier to accomplish that. And in fact, that 10-year CMA had come down to about 6.1, 6.2, yet we were still discounting the liabilities at 7.5. And I know internationally, the U.S. plans get a lot of critique about their discount rates or their assumed rates of return. But it's really the discount rate, I think, that can be really problematic if you're not carefully watching it. So one of the first things I was able to do was really work with the board and all of the stakeholder community. We have a very active stakeholder community here at Calpers, and really helping them to understand why this 7.5 was not going to be attainable without taking a level of risk that I knew our board was not that comfortable with. I knew the stakeholders were not going to be that comfortable with. So we went through and looked at a different kind of candidate portfolios that would get us closer to a 7% or improve the likelihood of a 7% over a 7.5%. So we were able to get that done in December of 2016, about 3 months after I started. So we felt good about that. We also felt good about, on the unfunded liability side, we changed the amortization policy. It was being financed over 30 years, those losses or anything that was different in the actuarial assumptions. And we were able to get that down to a 20-year level dollar amount for our public employers. So, for me, it was making sure that the underpinning of the system that the costs were built into the normal cost of these plans, which many of those now have 50-50 cost sharing, versus if we didn't get it right and we only had a 30% likelihood of hitting a 7.5%, for example, then all of that, unrealized capital was consumed as a debt by the public employer. So really looking at the financial underpinnings of the system, doing what we could quickly to make some, pretty significant changes in the type of environment that we have at Calpers. And now next year we go through that cycle in full. It's called our asset liability management, and another process that I think we've really shored up, over the last few years, that we need to bring stakeholders in. We need to bring business in, California business, because the taxpayer voice has become quite important here too, as we work to protect defined benefit plans and protect retirement security at a time when many, workers outside of the public sector do not have access to a retirement plan. So we have to make this successful. We need to make it affordable. So those two steps, I think we feel really good about. The other was the culture at Calpers. I'm a culture person. I want people who, when they come to Calpers, they feel like they can be successful. They feel like they have opportunities to grow, develop, promote if they choose to, and that this retention of that talent, how do we make sure that we don't have people just churning through the system because they might make a couple $100 more per month somewhere else, but how do we make sure that they see that they have promotional opportunities here? And what is the role of the leader, the behavior of a leader at Calpers versus, the boss? So we really worked more on that supportive, engaged leadership style to make sure that our teams felt like they could take any problem to their leader, and it wasn't, well, who made that mistake, but it's what happened, what happened in this process, and how do we make sure that we correct it at the source so that it doesn't, happen again. So, very proud of the culture, very proud of the team that we've been able to develop. Our retention has gone up, turnover has come down. And, and then challenging, probably the most challenging thing in this environment. And, sometimes you wonder whether you estimated it appropriately before you came in, because it's really tough to understand its impact without experiencing it. I tend to be more of an experiential learner, I guess. But the very public nature in which we try to run a public pension plan here, in California, and, the $415 billion portfolio does draw quite a bit of attention. It draws a lot of critique about the investment strategy or the returns or, private equity. We just spoke about private equity, and, there are certainly critics of that asset class. And so I think I underestimated that a little bit, but we have a very strong board, and we have, this relationship between the board and management, and we were able to work on some governance changes with this board over the last 18 months to really try to give the investment office and other parts of the business side, the management side, a little more time to do the work of the system versus, having that work of the system being transparent in a board meeting or in a stakeholder meeting. And so there's a good balance there, that we firmly believe in stakeholder engagement. We believe in transparency. We believe in getting everything that Calpers is doing, under two exceptions, but everything that we're doing, making it available. If anyone wants to know what our strategy is, then you have many places by which you can go and get that information. But investment strategy, we do try to protect some of our intellectual property and intellectual thinking until that strategy has been executed, and then we can report on it post. And then, of course, we have personnel matters, and we had turnover in our chief investment officer, and that, was really unfortunate. He was doing an outstanding job while he was here. But the bigger problem with that turnover is that, for Calpers, over the last 20 years, we've had 9 chief investment officers, and that kind of, inconsistency either in the investment strategy or managing of our investment team. We have 350 investment professionals here in Sacramento. Over 90% of the portfolio is managed in-house. And so that consistency and that stability is really the focus for next year, is how do we continue to improve. This year was flexibility. Just because of COVID, we need to be flexible with our team. But next year, it's all about stability. And the next chief investment officer, we need a minimum commitment of 5 years. So And then I think, the last thing I would comment on is very proud of the team and being able to set up this entire organization minus about 10% of the workforce whose job, well, less than 10, about 5% of the workforce, whose job just was not, you couldn't do that job from a remote location or from a home. But getting, essentially our entire workforce set up remotely, working successfully, working productively, within 2 weeks of, this pandemic hitting, is something, I think our entire team feels good that we were able to take care of our team, take care of our members, offer services that we used to do in person. We quickly pivoted over to offering those same services virtually without having any degradation in, our customer experience, our customer satisfaction ratings, our team engagement ratings. And so that, from a cultural standpoint, those are really strong predictors of future success.
Well, that is a long list, Marcy, of things that I think are accomplishments as well as obviously challenges going forward. I really appreciate you taking the time to share with us so many of your thoughts and insights in managing what is an extraordinarily large and important platform for so many people out there. So thank you for your time today. I really, really wish you all the best, and we look forward to seeing what the next 5 years bring for Calpers and all of the other institutional investors out there who do so much for the beneficiaries around the world. So thank you again for your time today.
Thank you. So nice meeting you too.